Welcome back to another educational video by Anderson Business Tax and Law Group. Today we're going to visit the 7 biggest tax traps that can destroy your retirement. When you're in that younger age and you're trying to accumulate those dollars, and you get to the older ages and then you try to get a distribution, sometimes people will look back over their lives and they'll say, gosh, look at these different phases in my life. I went through that first 0 to 18 to 25-year-old learning phase, and then I went through the earning phase trying to accumulate it all. And then depending upon how you plan, the last phase could be the yearning phase, or it could be considered the golden phase. That's your choice depending upon how well and how wise you plan. And unfortunately, you're going to have some enemies on this journey that you're on. And one of those enemies, and probably the biggest enemy, is going to be the tax code. The tax code increases by over 450 new rules per year, and it is considered the largest book or volume of books in the world. In addition to that, politicians are going to look to tax where the money is. Who has the largest bucket of assets? You got it. You do. The retirees. You've got it socked away because now you're into that distribution phase. So we're going to cover real briefly the 7 biggest mistakes that retirees make, and then during the class we're going to actually get into some of the solutions and possible structural changes to fix this or these problems. Let's talk about number 1, dividends and interest. Many people depend upon their dividends and interest to give them income during retirement. This is the old structure of retirement planning. This is one of the most inefficient ways to provide income. Now, the government loves this because it goes after what's called modified adjusted gross income and alternative minimum tax. That dividend and that piece of interest goes into that calculations. But these additional trigger taxes are really designed to tax someone who is weighted more towards investment gains and income rather than W-2 working income. Dividends and interest are taxed at the highest possible tax rate. Retirement trap number 2, mutual funds. The mutual funds have been the mainstay for retirement plans and 401ks since the late 70s, early 80s. But if you are in a retirement or mutual fund, it may be one of the most unfriendly investment partners you could have in your retirement. The reason is a mutual fund is a single-edged sword, and it's all weighted towards paying more taxes. When a mutual fund has a gain, they're going to distribute a 1099 to you. Now, this is going to happen whether you've lost or gained money on the fund. Imagine you've got $100,000 you invest. At the end of the year, it's worth $90,000. But you get a tax bill or 1099 for $20,000. That's because it's based upon the trading activity of the manager, not upon what it's worth. Now, a mutual fund may cause this surprise tax because they don't disclose their taxable distributions until the end of the year, not giving you much time to sell, change, or alter that. Now, you're going to share in all the taxable gains unless you actually sell your shares, there's no deduction. Now, let's use that example. Let's say it's a double-edged sword. That would mean that at the end of the year, if you invested $100,000 and it was worth $90,000, you sold it, you get a $10,000 deduction. But in this case, you will only pay the gains. You will not get a loss even if the manager takes a loss throughout the year. Retirement trap number 3, Social Security taxation. While you're working, you pay 6.2% of your income to Social Security and 2.9% for Medicare. That's up to a $117,000 limit on Social Security and unlimited for Medicare. If you're self-employed, you're paying both the employer side and the employee side. And the total for 2014 equals $7,254 for an individual, and double that if you are self-employed to $14,508. That means you could be triple taxed. You actually are taxed from all different avenues on Social Security. First, when you pay the tax physically from earnings. Second, you don't get a deduction for the tax that you pay. So you're actually going to pay federal tax on the actual Social Security tax. Then when you retire, you're going to be taxed up to 85% of your Social Security if you're making a measly $33,000 to $44,000 per year. Retirement trap number 4, municipal bond interest. Well, many brokers convince people to buy municipal bonds because they're tax-free, but they fail to tell people that there are what's called AMT non-exempt muni bonds. And they also fail to tell people that that muni bond interest goes into your modified adjusted gross income adjustment to determine a couple things. Number one is, will you pay tax on your Social Security? And now with the Obama surcharge tax, that also goes against your modified adjusted gross income. Retirement number 5, life insurance. Life insurance that has aged, meaning it's older than 10 years, has dividends and interest. Dividends that exceed the cost basis are going to cause annual taxation to the retiree. And unfortunately, many insurance agents convince people to buy life insurance because it's tax-free. But then some of them, they find out they're actually paying taxes on annual dividends. And in a lot of cases, people don't even see or know that they're paying the tax on the dividends on the life insurance. On to retirement tax trap number 6, itemized deduction limits. One of the ways that retirees depend upon cutting down their taxes in retirement is their itemized deductions. Unfortunately, the government has changed Schedule A to work against you if you're retired. All of your medical insurance premiums, Medicare, deductibles, prescriptions, long-term care insurance, dental and vision are reduced by 10% of your total income. Here's an example. Let's say you add up all your income. Dividends and interest, 10 grand. Social Security, taxed at 85%. Let's say that that's equal to 20 grand. Capital gains from mutual funds, because they make that distribution whether you like it or not, 15,000. Required minimum distributions from IRAs, 40,000. Total, $85,000. You would lose the first $8,500 in medical deductions. For many, you may lose your entire deduction. Let's talk about retiree tax trap number 7, the tax bomb on retirement plans. This is by far the biggest and most damaging problem to retirees. One of the reasons is that at age 70, you're forced to take your money out of your IRA. As an example, if you added up all your retirement plans and your total is $1 million, your first year taxable distribution is going to be about $40,000. The required minimum distribution can increase your total tax bracket due to it's added on to all of your other income. The required minimum distribution can cause taxation on Social Security due to the income limitations on Social Security, which we'll cover in another video. The required minimum distribution can cause the loss of your medical deductions, because remember, it's added back into your modified adjusted gross income. And to end it up with probably the worst possible outcome, at death, your IRA can be taxed up to 65% due to federal income tax, estate tax, income in respect of decedent's tax, and possibly state income tax. Now, when you attend the upcoming class, we will be covering some of the structures, strategies, and concepts on how to fix this problem. Thank you for joining us today on the 7 biggest tax traps that retirees face.